All right, let's jump right into it. Welcome to this explainer, where we're going to decode the incredibly complex, completely invisible forces that actually dictate the value of global currencies. Seriously, if you've ever stared at a currency exchange board at an airport and wondered who or what is actually pulling the strings, you are in the exact right place.
To kick things off, let's picture a pretty relatable scenario. Meet Bob. Bob lives in the US, and he uses the US dollar every single day, buying groceries, paying his rent, you know the drill. But then, Bob packs his bags and decides to travel. Suddenly, that exact same wallet he carries holds vastly different purchasing power depending entirely on the invisible made-up border he just crossed. It really begs a fundamental question, doesn't it? Why doesn't money just have the same value everywhere?
And this right here perfectly highlights the confusion. When Bob lands in Germany, he figures out pretty quickly that his $1 is only equal to about 90 euro cents. But then he catches a flight over to Vietnam, and boom, suddenly that exact same $1 piece of paper is worth 25,000 dong. It highlights just how totally abstract currency valuation actually is. I mean, the physical piece of paper didn't change at all, so what did? Well, that is exactly the puzzle we're going to solve today.
So here's our game plan for today. First, we'll look at the shift from gold to fiat money. Second, inflation and currency demand. Third, interest rates and investment. Fourth, global trade and pegged currencies. And finally, we'll wrap it all up with the world currency dilemma. Let's get to it.
Section 1. From gold to fiat money. So, to really understand the constantly fluctuating system we live with today, we've got to rewind a bit and look at the historical foundation of money. For the longest time, money was directly linked to precious metals. Back in the 1800s, we operated on what was called the gold standard. Basically, a country's currency was backed by a fixed amount of actual physical gold sitting in a vault somewhere. And this was great for stability. Governments couldn't just wildly print money without having the literal gold to back it up. But fast forward to the mid-1900s, and economies were just growing way too fast. Global trade was exploding. It actually became a logistical nightmare to keep enough physical gold stored away to back up all this massive new economic activity. So by the 1970s, the entire world made a huge shift away from this rigid system.
And what eventually replaced that gold standard? Fiat money. Now, fiat money is absolutely not backed by physical assets like gold. It operates entirely on, well, belief. It has value simply because the government says it does, and honestly, more importantly, because the public actually believes it does. Since it totally lacks physical backing, its value is strictly driven by supply and demand. If people want it, like the highly demanded US dollar, its value goes up. But if nobody wants it, like we saw in Venezuela where they had just devastating hyperinflation, the value plummets. It's all a massive game of trust.
Section 2. Inflation and currency demand.
Okay, let's talk about the first major variable that can completely wreck or boost a currency's value: inflation. Inflation basically happens when there is more money circulating around compared to the actual products and services available to buy. When a country has high inflation, its currency starts actively melting away its purchasing power. Just look at this breakdown. In 2022, let's say $10 buys you 2 loaves of bread. But by 2024, that exact same $10 bill only buys you 1 loaf. You're getting less stuff for the exact same amount of cash. And logically, nobody wants to hold on to a currency that's actively bleeding value, right? So demand drops, and the currency's overall global value drops right along with it.
600,000. I really want you to think about that number for a second. By the 2000s, that is how many Zimbabwean dollars it took to equal just one single US dollar. It is a staggering, frankly tragic fall, especially when you consider that back in the 1980s, the Zimbabwean dollar was actually stronger than the US dollar. It was sitting at a totally respectable exchange rate of roughly 1 to 1.35.
So how in the world did that happen? Well, it was a totally disastrous perfect storm. You had failed land reforms, severe economic problems, massive corruption, heavy international sanctions, and, perhaps the biggest nail in the coffin, a government that tried to solve its problems by just mindlessly printing more money. It completely eroded public trust. Things got so incredibly bad that they literally had to temporarily abandon their own native money entirely. They started using the US dollar and the South African rand just to keep their economy breathing.
Section 3. Interest rates and investment. All right, let's shift gears to interest rates. You can think of interest rates as essentially the price tag on borrowing money, expressed as a percentage. When a central bank raises these rates, they're essentially offering better returns on investments, like government bonds. Walk through this with me real quick. Step 1. You lend the government $1,000 by buying a bond. Step 2. Because interest rates are high, the government pays you a 5% return. So $50 every single year for 10 years. Step 3, you finally get your original $1,000 back. The logic here is super simple. Higher interest rates equal higher investment returns. And that acts like a massive magnet for foreign investors. But here's the kicker. To buy those local bonds, they have to buy the local currency first. That skyrockets demand and strengthens the currency's value.
Now you might be wondering, well, hold on. If high rates attract all those investors and strengthen the currency, why don't central banks just crank interest rates up infinitely high? Well, actually, scratch that idea, because there's a massive downside. High interest rates also mean incredibly expensive borrowing for the locals. If it's too expensive to get a loan, well, fewer people buy homes, fewer entrepreneurs start businesses, and the whole economy can just grind to a halt, leading to major unemployment. Central banks are constantly walking this terrifying tightrope, constantly adjusting rates based on whatever is happening on the ground at that exact moment.
Section 4. Global trade and pegged currencies.
Let's zoom out even further. A country's currency is heavily driven by foreign interactions. If foreign businesses want to build factories, like when China opened its massive markets back in the late 1970s, they need the local currency to buy land and pay their workers. That creates immense demand. Similarly, if Japan is exporting a massive number of cars, buyers all around the world have to acquire Japanese yen just to pay for them. And then you've got global commodities. Take the petrodollar system, for example, where the U.S. convinced nations like Saudi Arabia to sell their oil exclusively in U.S. dollars. Since literally everyone needs oil, everyone needs dollars. But keep in mind, foreign investors only bring their cash if a country is stable. Nobody likes sudden rule changes, surprise taxes, or massive protests disrupting their factories.
But what if you're a small nation? You don't export a ton of stuff, but you still really want a stable, reliable currency without the daily headache of fluctuating markets. Well, you use a clever trick called a pegged currency. Look at Brunei. It's an oil-rich nation that pegs its dollar exactly 1-to-1 with the Singapore dollar. The value is perfectly identical, making trade seamless. Or take Belize, which pegs its currency 2-to-1 with the US dollar. You literally don't even have to look up the exchange rate. You just double the amount in your head. It makes international trade utterly effortless for these smaller economies.
There is, of course, a massive catch. While pegging is unbelievably convenient, it completely tethers your nation's economic survival to a foreign power. You are entirely dependent on their stability. If the US dollar takes a massive hit, the Belize dollar plunges right alongside it. If one currency dies, the other one dies with it.
Section 5. The World Currency Dilemma.
So, putting all this together, you've probably asked yourself at some point, why don't we just skip all this hassle, eliminate exchange rates completely, and just use a single global currency? Well, the euro is the perfect real-world case study for this. On one hand, you have absolutely incredible convenience. You get completely borderless travel across the Eurozone without ever having to visit a sketchy currency exchange booth. But there is a massive risk. You entirely lose control over your own national monetary policy. Individual countries essentially surrender their ability to tweak their own interest rates or print money to fix their unique domestic issues. They have to hand all that power over to a central authority, like the European Central Bank.
And the danger of that exact trade-off became terrifyingly real back in 2009. When Greece experienced a massive financial crisis, they couldn't just isolate the problem using their own monetary tools because they shared a currency with everyone else. So the economic shockwaves spread rapidly across the entire Eurozone. It's a perfect example that proves in a single currency system, one country's mismanagement halfway across the continent suddenly becomes your immediate, very real problem.
Plus, here is a twist that might actually surprise you. Not every country even wants a super strong currency. It depends entirely on their economic survival strategy. An importing nation, like Singapore, absolutely wants a strong currency so they can buy goods from around the world as cheaply as possible. But a massive exporter, like China, they actually benefit from having a slightly weaker currency. It makes their exported products cheaper and way more attractive to the rest of the global market.
So, I'm going to leave you with this final thought to chew on. Should we really be cheering for our currency to be as strong as humanly possible? As we've seen today, a quote-unquote strong currency isn't just an absolute universal win. It's this incredibly delicate, fascinating balancing act of inflation, interest rates, global trust, and trade. The numbers sitting in your wallet right now are tied to a wonderfully dynamic global puzzle. Keep that in mind the next time you cross a border. Thanks for hanging out with me for this explainer, and I'll catch you next time.